This is a lesson about auditor independence. According to the auditing standards, auditor independence has two equally important aspects: independence in appearance and independence in fact. Independence in appearance is doing things and saying things that lead people to believe that the auditor is not independent from the client. That's different than whether the auditor actually is independent. The idea of these two concepts together is that the profession believes that auditors must appear to be independent from clients in order for the public to think that they are independent. Because most of the time, members of the public don't have the ability to know if the auditors are independent. They just have to presume that the auditors are following the independence standards. Independence in fact could be threatened in three ways. First, there might be a conflict of interest between the auditor and the client. This arises from things like the auditor's pay or family relationships between members of client management and members of the audit firm's management. Second, the auditors could be required to audit their own work. This arises from circumstances where the audit firm has provided consulting and given advice that the client accepted, and then the auditor later is forced to audit the results of that consulting advice. And the third source of independence in fact issues comes if the auditor is put in a position to advocate for the client. We cannot be the judge of the client and an advocate of the client. We must be one or the other. As you can read in the book, there are different kinds of financial relationship rules for auditor independence. One of the most common financial relationships between auditors and their clients is lending relationships. The auditing standards specifically allow the client to issue a mortgage to the auditor. The reason that this is specifically permitted is that auditor-client relationships could be much shorter in term than auditor-bank relationships for mortgages. A second common kind of financial tie between a client and its auditor is stock. Quite commonly, auditors have investments in stock, in retirement planning and investment strategies and so forth. And there are many rules that pertain to the issue of whether clients or whether auditors can own their client's stock. The most important rule is that you can never own stock in a client if you work on the audit of that company. Family relationships between audit firm and client can also cause problems for independence. In general, relationships between the people working directly on the audit and client personnel are only of concern if the people who work for the client, the relatives who work for the client, are involved in the financial management of the company. So your mother could be the CFO of the client company, and that would cause an independence problem. Your mother could also be the head of marketing for a client company, and that would not cause an independence problem. The family relationships of concern for auditor independence are the auditor's generation, you, one generation below, your children, and one generation above, your parents. So your siblings are in your own generation, your parents are one generation above, and your children are one generation below. The people in that set are of concern if some of the people work for the audit firm and some of the people work for the client. Now let's move on to talking about independence in appearance. Independence in appearance is threatened when the auditor makes comments beyond the audit team about client personnel. If you talk about how sharp the people are, or you talk about how the fact that the client doesn't really understand what the auditors are doing, and so you're able to vastly overcharge them. Those kinds of comments are not only unethical, but they're also violations of auditor independence. Auditor independence rules lets the personal relationship with the client move beyond a business relationship. So you can be friends, but if people who observe the friendship think, oh, you're best friends, and therefore you're probably not doing the greatest audit in the world, you're probably not independent, then you have an independence and appearance problem. As you heard at the SAS Madoff Asai meeting last week with EY, there are independence problems that can emerge during the audit that are caused by the way the audit is set up and by the way the auditor collects and analyzes data during the audit. First is the self-interest threat. This is the threat that you conduct the audit in a way that acts in your own best interests. You do things that are the fastest for you or the easiest for you. You do the things that are the most profitable in terms of reimbursements for travel. The self-review threat arises from the simple fact that it's very difficult for someone to fault their own reasoning or to see the flaws in their own work. The self-review threat is one of the main reasons behind the auditing standard requiring supervisory review of all audit work. It's very hard to do the work and then come along the next way and see the mistakes in your analysis or the logical failures that you have. These are some of the other problems that emerge during the audit as we look at evidence. So keep in mind that during an audit, there could be 6 or 8 weeks from the time you collect the first audit evidence to the time you collect the last of the evidence. The confirmation bias is the problem of only looking for evidence to confirm what you think a client's balance should be. If you think a client's balance is overstated, you do an audit in a certain way. If you think a balance is understated, you do an audit in a certain way, and that automatically excludes other kinds of evidence. The anchoring bias is the problem of basing your conclusions on the client's balances and the starting values and the early evidence in the audit. You anchor on what you see first and place less importance on the stuff you see later. The opposite of anchoring, really, is recency, the tendency to give more weight to evidence collected at the audit rather than the evidence or the beginning balances or the evidence at the beginning. An example of the recency bias can be seen in analyzing accounts receivable confirmation responses. Clients reply back agreeing. All of the confirmations come back. The customers agree with the client's balance. And then the very last confirmation you receive, the customer says, no, I don't agree. I don't owe this money. If the recency bias is in effect, that last one that you see has more importance than all of the earlier ones. Neither anchoring nor recency should exist in an ideal audit. All of the evidence should be considered in its entirety and not the earlier evidence more important or the later evidence given more importance. Another very important source of auditor independence issues arises from the fact that many auditors end up going to work for their audit clients. Problems include the client being able to guess audit procedures better because the person now working as the client used to be on the audit team. Another independence issue could arise because the new audit team won't work as hard because they know their former boss, who they thought really highly of, is the accountant at the client now. You could also have an independence in appearance issue with this kind of situation because people would say that the auditors and the new accountant working for the client are such good friends that you would not get a very high quality audit. There are standards specifically aimed at this issue of the auditor going to work for an audit client. The three basic requirements before the auditors move on to the client are: first, when an auditor is approached by a client to come and work for them, the auditor has to report the offer to their boss. Whether you're looking for a new job or not does not matter. If the client offers you employment, you have to report it within the accounting firm to your immediate boss. As soon as you decide to pursue working for the client and enter into negotiations, or seriously think about leaving the audit firm, you're supposed to report that as well and remove yourself from that audit. And as soon as you remove yourself from the audit, the firm is supposed to do special review of your work and document the special review, specifically looking for instances where you might not have done the work as you would have if you were not going to work for that company. Then after you go to work for the client, the auditors must consider and document the need to change their audit approach. Now that you know how the audits are conducted at that company and you're an accountant for the company, you can help the company predict how the audit's going to go. So they might need to change the audit approach, and they might also need to change the audit team if the team does not feel they're independent. Finally, there can be no lingering financial ties between the person who's the new accountant for the client and the audit firm. So you have to settle all the sick pay and retirement plan and everything else before you go to work for that audit client. Otherwise, the audit firm will not be considered independent of the client.